At MenthorQ, we understand the complexities and rapid movement of the futures options market. That's why we are excited to introduce our latest product development, gamma and liquidity levels on futures options. These levels can be used if you are trading directionally by buying or selling futures, or if you want to use futures options within your strategy. They will provide a clearer path. Have you ever felt lost when looking at the chart, not knowing which side of the trade to take? Have you lost money on fake pullbacks or trend reversals? And how many times did you make too many trades because you believed your idea was right, but the market simply did not react? This is called revenge trading and can be very dangerous. Let's look at this chart. This is the MenthorQ net gamma exposure chart that shows market positioning on the Nasdaq future. The red bars highlight a large amount of put positioning. This brings us to gamma levels, and now we can leverage the information coming from the options market. This brings us to the basics of options. A put option is basically a safety net or an insurance that allows you to sell your stock at a predetermined price, even if the market price continues to drop. And what if you knew that on the other side of the trade there is a market maker that provides the price? Market makers are key to the market. They are always there, ready to buy or sell stocks or options, ensuring that there is always enough liquidity to keep the market running. In the case of options, the majority of transactions are executed by a market maker. Market makers don't really care whether the price of a stock goes up or down. The market maker does not make money from trading, but from executing trading volumes and charging a bid-ask spread. This concept is really important. So by doing this, market makers take on the risk in case the price of a stock moves. But they don't really want to gamble on whether the stock will rise or fall. Their job is to facilitate trades and provide liquidity. So if a lot of investors start to buy put options because they're worried the price of a stock might go down, what does that mean for the market makers? Well, if the market really starts to fall, all these investors will want to use their put option to sell their stock at the higher price, which could potentially put the market maker in a tricky situation because they have the obligation to buy these stocks at these prices. By selling put options or the insurance, market makers are now forced to buy the stock at higher prices. If the market keeps dropping, they might have to buy a lot of stocks at prices much higher than the market value, which could mean greater losses. To protect themselves from losing money in this scenario, market makers use a strategy called delta hedging. In the simplest form, that means that the market maker is always hedging its portfolio. As we said before, they are not making money on directional movement, but by executing trades and charging the bid-ask spread. To hedge against movement, they delta hedge their portfolio by buying or selling the underlying asset. This topic can be complicated, but we have a free documentation within our website under the resources section. This activity is like their own insurance. It allows them not to lose money when the market falls. They do this by making their own set of trades that balance out the risk they are taking when they sell put options. If the market drops, these balancing trades help them not lose out because they have other positions that gain value. They want to keep a risk-neutral position. This concept can be quite complex, but in simple terms, knowing where the market is positioned on the put or call side allows us to identify those reaction zones that will become very important as the price approaches those levels. We know that if that happens, those options that were previously out of the money are now in the money, and the market makers will react to protect against losses, and these reactions could add or remove liquidity to the market. It's time to introduce you to gamma levels and how they can help you within your trading plan. We know that the option market has become increasingly important for different reasons. The increase in option volumes can increase or reduce liquidity in the market, and being able to track the liquidity can help you increase profitability or risk management. Option flows creates technical moves in the market because of how market makers have to hedge their risk. Understanding options positioning is key for anyone who is trading stocks, futures, or options. Now let's look at some examples on using gamma levels on futures. But what are gamma levels? They are key price levels where there is more negative or positive gamma based on option positioning and open interest. By looking at the option data, we can define sticky price levels that can help us define our trading plan. They are reaction zones where the market will react if the price approaches the level. Here we can see how we can define those levels by looking at our net gamma exposure chart. If we go back to the example of you driving at night with only the front light of the beam, gamma levels help you understand what is going on around us and how the market is reacting. They are not a crystal ball and cannot predict the future. They provide us with a statistical advantage that allows us to improve our strategy. Remember, there is no model in the world that can predict the future. What we have developed is a system that allows us to translate the information contained in the option market into actionable information. We then simplify the data and plot it into the chart, giving you a clearer picture of what is around you. But why are they called gamma levels? Gamma is a measure of the rate of change in an options delta with respect to the change in the price of the underlying asset, and it's key in the delta hedging activity of the market makers. The overall gamma exposure in the market can be positive or negative. But why is this important? Because, as we explained earlier, the market maker is constantly hedging his portfolio by buying or selling the underlying asset. The overall gamma exposure will affect how the market maker is hedging, and this will have an effect on the price action in the market. Let's try to simplify this in a few sentences. The difference between positive and negative gamma is another important aspect to understand market dynamics. We know that in positive gamma, the overall market is long options. The market makers buys when the underlying falls and sells when the underlying goes up. This is how they stay delta hedged. This activity keeps intraday volatility low, and knowing how volatility will be before the market opens is a very important clue for a trader. And remember, to be successful, you need to trade in the right direction of volatility. In negative gamma, instead, the market makers hedges by selling the underlying when the price falls and going long when the price goes up. This creates more volatility in the market, and when we are in negative gamma, we can see big price swings during the day. Again, an important clue for a trader. We have simplified this, and every day you can check the gamma condition of your asset within the premium membership before the market opens. With the MenthorQ levels indicator, you can now add gamma levels to your charts, adding a clear picture of the market and better signals for your trades, take profit targets, and stop losses. Gamma levels are divided into primary levels and secondary levels. Let's start with the primary levels and are called resistance level. The core resistance level is the price level with the most net gamma when it comes to calls. Generally, this is the level with the most upward resistance. Let's take the MenthorQ net gamma exposure chart to better understand why this level can become a reaction zone. The core resistance level is the strike price with the highest net call gamma. This is represented by the wider green bar. This also means that this is the level where there is the most call open interest and call gamma. Investors have been buying out of the money call options at that strike price. But why does it become a resistance level? If we think about market mechanics, we know that the market maker is going long to hedge against the investor call options. As the spot price moves closer to the core resistance levels, those calls that were previously out of the money start moving into the money. At that point, investors that were long out of the money call options start closing those positions. And the reason is obvious. If you're long an out of the money call option, you want to monetize it when it moves into the money, whether you're a hedger or a speculator. That is the main reason why the core resistance becomes a resistance. As investors close those call options, market makers will also adjust their delta hedges. Remember, market makers were going long to hedge those calls. Once those calls have been closed, the market makers has to close their long exposure, and this stops the market from moving above this level. Now, can the spot price break above this level? It can indeed, but it requires a further catalyst. Let's take the example of GameStop in 2020, when investors were buying calls, forcing the market makers to continue to go long to remain delta hedge. That was a bullish force on the market that kept forcing the market higher. So how can we use this level in our trading? Similar to how you would use a resistance in technical analysis, our core resistance can be used in the same way, but it encompasses the power of options data. We can use this level as a resistance or reaction zones where the price slows down its uptrend and can bounce to the downside. If you are in a long trade, you can use this level as a profit target area, and if you're looking for a reversal trade, this can be an efficient level of entry. The core resistance can also be an inflection point for an acceleration to the upside, similar to the GameStop example. If there is a bullish sentiment in the market, a break above the core resistance level can bring upside momentum. Let's look at this chart. This is the chart of Nvidia at the end of March 2024. We are in a strong uptrend, and on March 26, the price is approaching the $1,000 mark. Here we see the net JAX or net gamma exposure chart from our models, and we can identify two key levels, the core resistance and the core resistance 0 DTE, which looks at the market positioning at the next weekly expiration. The 1000 level and the 950 level are the one with the highest exposure. As we can see from the chart, the price reaches this level and then retracts, if fails to break above. Another important level is the put support. The put support level is the strike with the highest net put gamma. Generally speaking, is the level with the most downward support. Let's take the net gamma exposure chart to better understand why this level can become a reaction zone. The put support level is the strike price with the highest net put gamma. This is represented by the wider red bar. This is also the level where there is the most put open interest and put gamma. Investors have been buying out of the money put options at that strike price. But why does it become a support level? If we think about market mechanics, we know that the market maker is going short to hedge investors' put options. As the spot price moves closer to the put support level, the puts that were out of the money start moving into the money. At that point, investors that were long those out of the money puts start closing those positions. If you are long out of the money puts, you will start to monetize them as they become in the money. As investors close those puts, market makers will also adjust their delta hedges. Remember, market makers were going short to hedge those puts, and as the puts are closed, the market makers close the short exposure. That stops the market from moving below that level. The price can definitely break below this level. We have seen that happen before. But that would require a further catalyst. An investor will need to buy put option below the current level, driving market makers to continue to short the market to stay delta hedged. This brings us to the high vol level, or HVL. The best way to understand this level is by taking the net jacks chart and looking at the jack slope in yellow. If you follow that curve up and down, you can see that it tracks the cumulative jacks. Said it more simply, the line helps us understand when we are in a positive or negative gamma environment. The high vol level tells you at which point the slope of the jacks profile starts changing from positive to negative and vice versa. For example, if the spot price starts moving towards that level, we start seeing an increase in price volatility because it means that the market is increasingly moving towards the negative gamma environment. The opposite happens when the price moves higher from a negative gamma environment towards a positive gamma environment. Above or below that level, market makers may change the way they hedge. In a negative gamma environment, market makers accentuate volatility. For traders, understanding this volatility shift is very important because it will also affect the type of strategy you should use. Remember, to be successful, you always need to be on the right side of volatility. Then we have our one-day expected move indicator. The goal is to forecast the next day price action. It has an upper and lower band, the one-day max and the one-day minimum. The one-day max is the maximum price move that, according to the indicator, can be expected for the next day. The one-day minimum is the minimum price move that, according to the indicator, can be expected for the next day. So now you might be asking, does the indicator actually work? And how is it possible to forecast the next day price movement and volatility? The indicator is backed by data. We have backtesting results on our website. For example, if we look at the SPX index, here are the results over a 4-year period. What we found very interesting was the directionality. The one-day expected move indicator worked better than we expected. The price of the SPX closed above the one-day minimum on 87.62% of the time and closed below the one-day maximum on 85% of the times. By knowing this, you can now use a quant data approach to your trading. We see a similar results also on stocks. Here you can see some of the backtesting data on some of the most traded stocks. You can also find this data on our website. On top of the primary levels, we have the secondary levels, which are the jacks level 0 to jacks level 10. They represent the bars with the highest gamma exposure, as we can see from the net jacks chart. Similar to the primary levels, they represent reaction zones. You can plot them on the chart by using our TradingView integration. You can find the levels within our premium membership.